While the US refuses to admit it, nearly everyone believes America aims to boost its manufacturing export edge and dilute its debt through dollar depreciation. The dollar's weakness over the past month has already reflected this expectation, and reasonably so, as every industrialized nation seeks currency devaluation to make its exports cheaper on the global market, with some even periodically labeled currency manipulators over it. Thus, the debate is not whether the US wants the dollar to depreciate, but whether it can. Historically, the US has done so multiple times in blunt fashion. During the Great Depression, Roosevelt devalued the dollar by nearly 50% against gold overnight. In the 1970s, Nixon decoupled the dollar from gold, causing a 20-fold depreciation over a decade. And in the iconic 1985 Plaza Accord of the fiat currency era, the US and for other nations Japan, France, the UK, West Germany jointly sold dollars to weaken it, aiming to enhance US manufacturing competitiveness and reduce trade deficits. Yes, the US has sought to cut trade deficits for decades, at least overtly. Contrary to today's online narratives that Japan was forced to sign by the US, historical truth shows both sides mutually cursed each other as fools before gladly signing. Japan's finance minister Noboru Takeshita even proposed the meeting, and all of Japan celebrated the accord's perceived benefits, with both nations convinced they had secured the best deal. Yet the outcome shocked everyone. If the accord was truly malicious, why did Japan eagerly embrace what seemed like a self-inflicted wound? Would America's major trade partners today, including China, repeat this dollar devaluation strategy? The Plaza Accord's story is crucial for understanding current and future global economic upheaval. Post-World War II, the US-Soviet Cold War entered a new dimension with the Korean War, as both powers sought to groom frontline proxies, North Korea for the USSR, Japan for the US, to demonstrate their system's superiority. This geopolitical rivalry explains Japan's rapid post-war rise from ruin under US aid. By the early 1970s, Japanese manufacturing had shed its shoddy knockoff stigma to become synonymous with affordability, durability, and sophistication, driving a manufacturing export boom. Panasonic, Toshiba, Sony, Canon, Yamaha, etc. Meanwhile, the US, trapped in the 1970s oil crisis, saw manufacturing costs surge, making Japanese products cheap and high-quality dominant over expensive, bulky American goods, effectively hollowing out US manufacturing. Japanese goods dominated the US for a decade, largely due to politics. 3 successive US presidents, Nixon, Ford, Carter, prioritized free trade and barely intervened in growing trade deficits, adopting a let-everyone-compete fairly stance. This changed in 1981 with Reagan's arrival. Emerging from a decade of stagnation, the US sought recovery via Reagan-Thatcher neoliberalism, tax cuts, deregulation, capital liberalization, and floating exchange rates. Looser rules and tax cuts attracted global capital to the US, but most flowed into financial assets rather than manufacturing due to high US production costs, fueling a financial services boom while crippling manufacturing. Rising demand for dollars to buy US assets drove up the dollar's value, amplifying Japan's export price advantage and weakening US products. The final straw came from the Fed in the early 1980s. To combat resurgent inflation, Fed Chair Paul Volcker raised rates above 20%, making the dollar even more attractive and sending its value surging. Between 1979 to 1985, the US dollar index doubled, effectively having the price of Japanese exports in America a currency-driven boom that supercharged Japan's manufacturing dominance as US industry continued to shrink. By February 1985, with the US dollar at an all-time high, American manufacturing was effectively on life support. Reagan could no longer wait, yet trapped by inflation, he couldn't cut rates quickly, a dilemma akin to today's challenges. High rates continued attracting global capital, making market-driven dollar depreciation impossible. Was US manufacturing doomed? The Reagan administration then presented the Plaza Accord, a modern economic unequal treaty, to the leaders of Japan, West Germany, France, and the UK, for core US allies. These nations, seasoned players in global capitalism, weren't naive to America's coercion. Logically, the deal should have failed due to US unilateralism, but Reagan was confident thanks to the Soviet Union. In the early 1980s, just before the Accord's signing, the USS staged Western 81, the largest military exercise in history, explicitly aimed at intimidating the West. With over 500,000 troops, 10,000 main battle tanks, 14,000 armored vehicles, 8,000 artillery pieces, and 1,500 bombers. The drill included live nuclear strike simulations on NATO front lines, unprecedented in scale and provocation, designed to counter rising skepticism about the Soviet economy amid falling oil prices and internal instability. Aging leadership under Brezhnev, the exercise terrified Europe and Japan. Europeans contemplated laying nuclear mines along the Warsaw Pact border to halt the steel tide, while Japan locked in territorial disputes with the USSR and within range of Soviet Far East forces felt equally vulnerable. The military parade bolstered Reagan's Strategic Defense Initiative Star Wars and convinced Japan to sign the US-Japan Defense Cooperation Guidelines, militarily tethering itself to America. Crucially, it revealed Allies' mortal fear of the USSR, a lever Reagan exploited. The US wants your money, the USSR wants your lives. This fear became the foundation of US confidence. Yet during negotiations, Japan and others agreed almost instantly, surprising even the US Secretary of State. Why? Japan had its own agenda. As the world's second largest economy, Japan coveted more than just exporting to America. It sought to become America's boss by acquiring US assets. A chronically undervalued yen had hindered Japanese corporations from global mergers. The Plaza Accord was a godsend for revaluation advocates within Japan's zaibatsu, who saw yen appreciation as essential for overseas expansion and yen internationalization. Prime Minister Yoshihiro Nakasone argued, "A strong Japan needs a strong yen." For a post-World War II nation stripped of political sovereignty, a globally influential yen promised unprecedented political and economic clout. But didn't Japan foresee that yen appreciation would hurt exports? It did, but misjudged the scale. At the time, Japan's top leaders widely believed that even after signing the accord, the yen's appreciation would remain moderate. According to minutes from Japan's Ministry of Finance, then Finance Minister Noboru Takeshita stated that even if the yen rose from 220 to 190 PUSD, a 20% appreciation, it would be manageable. His confidence stemmed from historical precedent, when the dollar decoupled from gold in the 1970s, risking systemic collapse. The yen had only appreciated 26%, yet Japanese products continued dominating the US market. Thus, Japanese officials were convinced that modest yen appreciation would not fundamentally undermine their exports, a testament to Japan's overconfidence in the 1980s. But as history shows, the unexpected soon unfolded. In 1985, the yen began appreciating per the accord. Anticipating reduced export competitiveness, Japan preemptively cut domestic interest rates to stimulate the economy, a move that inadvertently sent the economy from booming to bust. With low rates, savings fled banks, but Japan already passed its consumption boom. Rural home appliance penetration exceeded 80% in the 1970s, with even cameras surpassing 60%, lacked productive outlets for capital. Instead, decades of savings, leveraged exponentially, poured into stocks and real estate, fueling a speculative frenzy. By late 1989, the Nikkei index hit 39,000 times its 1985 level, while land prices tripled in 4 years. Japan became a bubble economy where the only risk in investing was starting late, with startups securing angel funding in elevator pitches and international, especially US capital, flooding in to chase gains. This created a self-reinforcing cycle. Yen appreciation fueled asset bubbles, which in turn drove further currency demand and appreciation. Within a year of the accord, the yen's appreciation against the dollar exceeded the 26% safety line. 2 years later, it hit 86%, nearly 4 times Japan's projection. Even Japan's robust manufacturing couldn't withstand such drastic currency appreciation, while asset bubbles reached unsustainable heights. When everyone assumed prices would keep rising, the market exhausted all buyers, leaving only sellers desperate to cash out. The stock and real estate markets collapsed in early 1990, a stark reminder that consensus is most dangerous. The Plaza Accord became the trigger for Japan's loss to decades, compounded by ill-timed rate cuts that overheated the economy beyond recovery. What about the US, the Accord's other party? Did dollar depreciation revive manufacturing? Reality proved less straightforward. While the dollar fell 40% from 1985 to 1988, US trade deficits only shrank 13% as high production costs persisted. Japan's lost market share was seized not by America but by other nations. West Germany capitalized on free trade to snatch exports, while East Asian neighbors like South Korea, bolstered by US favor, absorbed Japanese technology and clients, giving rise to giants like Samsung and Hyundai. Though America's manufacturing revival failed, the US reaped benefits elsewhere, primarily in capital markets. Japanese funds flowed back into US Treasury bonds, providing cheap long-term financing that sustained decades of deficit spending. While manufacturing continued declining, US stocks and bonds rose amid dollar depreciation, a loss in industry, gain in finance outcome. From 1985 to 1989, the S&P 500 surged 65%, while US Treasury prices rose sharply, creating a stocks and bonds bull market that reinforced the dollar's status as the global reserve currency and America's role as a financial hub. The sudden collapse of the Soviet Union in 1991 along with the Warsaw Pact sent shockwaves through global politics, driving panicked capital back to the US. This influx of international funds, combined with dismantled Soviet assets and post-Cold War defense spending cuts, fueled America's internet and IT revolution, ushering in the prosperous 1990s. Today's tariff wars and attempts to devalue the dollar are not solutions for manufacturing resurgence. US policymakers understand this well. While their ethics may be questionable, their strategic acumen is not. The conditions that enabled the Plaza Accord cannot be replicated. The shared fear of socialism that once bound Western allies has vanished. The Plaza Accord's success relied on Cold War-era solidarity against the USSR. US allies today, including Europe, Japan, and South Korea, reject a new Cold War with China, given the interconnectedness of globalization. For example, Germany has openly opposed decoupling, highlighting how unilateral economic policies now risk collateral damage in an interdependent world. Ukrainian President Zelensky's February 2024 remark to Trump, "America doesn't feel global crises because the Bering Strait isolates it," underscores a key truth. America's geographic insulation has historically allowed it to pursue self-serving policies. As proven by two world wars, the 1990s boom, and the Ukraine conflict, US prosperity often hinges on global instability. This paradox, needing to export dollars to sustain their reserve status while shrinking trade deficits to reclaim them, drives Trump's contradictory policies. The goal is not manufacturing revival, a political ploy for blue-collar voters, but to instill fear in global capital, creating controlled chaos that funnels assets into US markets while preserving domestic stability. Mao Zedong's phrase, "When the world is in chaos, the situation is excellent," captures a dual reality. Old orders collapse painfully, but they can birth fairer systems. However, America's current strategy, thriving on systemic global risks, ignores that it remains intertwined with the old order, risking self-undoing. As such, the dangers of today's instability will persist, and only time will reveal the next chapter. Thank you for watching and supporting this discussion.